Welcome to this comprehensive guide on one of the most significant events in the cryptocurrency world, the Bitcoin halving. Whether you're a seasoned investor or new to the crypto space, understanding this predetermined event is crucial to grasping Bitcoin's unique value proposition and potential future price movements. This presentation will walk you through everything you need to know about the Bitcoin halving mechanism, its historical impact, and what it might mean for Bitcoin's future as we approach the next halving event in 2024. Let's start by outlining the key topics we'll cover in this presentation. We'll delve into Bitcoin's monetary policy, explore the halving mechanism, review historical halvings, and analyze the economic impact. We'll also look at price analysis and future projections. By the end of this presentation, you'll have a solid understanding of why halvings are pivotal events in Bitcoin's life cycle and how they might influence your investment strategy going forward. Bitcoin operates on a predetermined and unchangeable monetary schedule, unlike traditional fiat currencies that can be created at will by central banks. This includes a fixed total supply cap of 21 million Bitcoin, a predictable issuance rate that decreases over time, and a transparent monetary policy encoded in Bitcoin's source code. This fundamental property makes Bitcoin fundamentally different from every other form of money in human history, as it cannot be increased in response to demand, political pressure, or economic crises. Bitcoin's scarcity is engineered through its 21 million cap, which is built into its code and cannot be changed without consensus. New Bitcoin are created approximately every 10 minutes when a new block is mined, but the diminishing returns mean the amount of new Bitcoin created per block decreases over time. This engineered scarcity is foundational to Bitcoin's value proposition as digital gold, and sets it apart from both traditional currencies and other cryptocurrencies that don't have a fixed supply cap. The Bitcoin halving is a pre-programmed event that occurs approximately every 4 years, reducing the reward that miners receive for validating transactions by half. This mechanism is crucial for gradually reducing the rate at which new coins enter circulation, enforcing its deflationary monetary policy and increasing scarcity over time. The mining process involves miners competing to solve complex mathematical puzzles, and as a reward, they receive newly created Bitcoin, which secures the network and processes transactions. The mining reward system is integral to Bitcoin's operation. Specialized computers called ASICs consume electricity to solve puzzles in a process called proof of work. When a miner successfully solves the puzzle, they create a new block containing recent transactions and add it to the blockchain. As compensation for this work, the miner receives the reward of newly created Bitcoin plus transaction fees. Every 210,000 blocks, roughly every 4 years, this block reward is halved, which is the essence of the Bitcoin halving event. Bitcoin's history is marked by significant halvings that have influenced its price and market dynamics. The Genesis block in 2009 started with a block reward of 50 BTC, which was halved to 25 BTC in 2012, then to 12.5 BTC in 2016, and further to 6.25 BTC in 2020. The upcoming halving will reduce the block reward to 3.125 BTC. Each halving has marked a significant milestone in Bitcoin's history and has preceded major price movements in the subsequent 12-18 months. The chart above illustrates Bitcoin's programmed supply reduction over time, creating an increasingly scarce asset. This stepwise reduction continues until approximately the year 2140, when the final Bitcoin will be mined. At that point, miners will be incentivized solely through transaction fees rather than block rewards. Currently, approximately 900 new Bitcoin enter circulation daily. After the 2024 halving, this will drop to about 450 Bitcoin per day, representing a significant reduction in available supply. The halving creates what economists call a supply shock, a sudden and significant change in the supply of Bitcoin. Pre-halving, approximately 900 new Bitcoin enter circulation daily, worth around $54 million at $60,000 per BTC. Post-halving, this number drops to about 450 Bitcoin daily, representing a $27 million reduction in new Bitcoin entering the market every day. If demand remains stable or increases while new supply is cut in half, basic economic principles suggest upward price pressure, as supply cannot be increased to meet demand. The stock-to-flow (S2F) model is one of the most discussed analytical frameworks for understanding Bitcoin's value in relation to its scarcity. Created by anonymous analyst Plan B, it measures the ratio of the existing supply, stock, to the rate of new production, flow. This model has been remarkably accurate following previous halvings, observing that Bitcoin's S2F ratio jumps significantly after each halving. While critics argue that Bitcoin's nature makes it difficult to predict, the model is considered as one tool among many for understanding potential price movements. Price movements following previous halvings reveal a compelling pattern. After the 2012 halving, Bitcoin rose from approximately $12 to over $1,000 within a year, representing an 8,300% increase. After the 2016 halving, Bitcoin climbed from about $650 to nearly $20,000 in 17 months, a 2,900% increase. After the 2020 halving, Bitcoin surged from $8,500 to an all-time high of $69,000 within 18 months, a 700% increase. It's important to note that while the percentage gains have decreased with each cycle, the absolute dollar gains have remained enormous. This chart showcases each halving cycle, setting the halving date as the starting point, index equals 100, to compare percentage growth across cycles. While the timing and magnitude differ, all three previous cycles show substantial appreciation in the 18 months following the halving. Note that each cycle has had different market dynamics. The 2012-2016 cycle saw rapid early growth. The 2016-2020 cycle had delayed growth that eventually exceeded previous peaks, and the 2020-2024 cycle has followed a more measured path with significant institutional adoption. Several factors contribute to the delayed reaction to the supply shock, resulting in the characteristic post-halving bull runs that have defined Bitcoin's price history thus far. Efficient market hypothesis suggests the halving would be priced in before it occurs, but the supply reduction's full impact takes time to manifest as existing supply is absorbed by the market. Market psychology and awareness create a self-fulfilling cycle that typically peaks 12-18 months after the halving as awareness spreads. Institutional capital deployment and miner capitulation also play roles in this delay. The current halving cycle has featured several unprecedented developments that make it distinct from previous cycles. Institutional adoption by major companies like MicroStrategy, Tesla, and Square has added Bitcoin to their balance sheets. ETF approvals, regulatory clarity, and macroeconomic conditions have all influenced Bitcoin's market dynamics. This entry of major institutional players represents a fundamental shift in Bitcoin's market dynamics compared to previous halving cycles, potentially affecting future price movements. miners experience an immediate 50% reduction in new Bitcoin rewards, dramatically affecting their profitability. The halving creates significant pressure on miners, forcing the industry to become more efficient. Less efficient operations may be forced to shut down, while those with access to cheaper electricity or better mining equipment will survive. This miner capitulation can create temporary selling pressure as struggling miners liquidate Bitcoin holdings to cover operational costs. However, once this adjustment period concludes, the remaining miners operate in a more efficient ecosystem with reduced selling pressure on the market. The combination of reduced supply from the halving and increased demand from institutional adoption creates a potentially explosive formula for price appreciation, possibly exceeding previous cycles in absolute dollar terms. Supply shock is mathematical certainty, and institutions have accumulated over 200,000 BTC in their treasuries. Regulatory environments have established clearer frameworks for Bitcoin, reducing risks and enhancing its appeal as a hedge against traditional financial system risks and currency debasement. Global macro uncertainties, including economic, geopolitical tensions, and banking system stress, enhance Bitcoin's appeal. Each cycle has shown greater percentage gains with each cycle, although absolute dollar returns remain substantial. As Bitcoin matures, larger market capitalization gains may drive smaller growth. Additional bear factors include greater market awareness, regulatory headwinds, technological competition, and macroeconomic shifts. Higher interest rates make riskier assets less attractive compared to safer investments, potentially affecting Bitcoin's price appreciation. The bear case suggests that while the halving may not lead to explosive growth, it could still result in significant gains. The halving represents both an opportunity and a test of investor discipline. Those who approach it with careful planning and realistic expectations will be best positioned to benefit from any resulting market movements. Strategic timing considerations suggest that the most significant price appreciation typically occurs 12–18 months after the halving, not immediately before or after. Position sizing and risk management are key, as they are not guarantees of future performance. Educational preparation and technical security are also crucial for maximizing potential gains. Monitoring key metrics around the halving is essential for understanding Bitcoin's fundamental health. Miner revenue, electricity costs, exchange inflows, outflows, market indicators, ETF flows, and funding rates are all important factors to watch. Rising open interest with price increases suggests conviction, while continued strong inflows suggest institutional demand remains robust. On-chain metrics provide unique insights into Bitcoin's fundamental health that aren't available for traditional assets, offering a deeper understanding of market dynamics. The Bitcoin halving is more than just a technical event, it's a statement to Bitcoin's unique design as programmable, predictable money. Each halving reinforces Bitcoin's digital scarcity, potentially enhancing its value proposition. As we approach the 2024 halving, both new and experienced investors have an opportunity to witness and participate in the economic becoming of a unique form of money. Understanding the halving's significance is key to navigating the market cycles that may follow.